and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey everybody, happy January. Happy 2025. Here we go. Buckle up. Clean slate. Nothing matters except for now. So P&L's been reset in the broker platform, off to a pretty good start for the year. Still plenty of time to grind. But taking a look at where we are at, market is trying to make a bit of a swing. I want to put some reference here. I was talking to my members early this morning for a live session. So right here is the December 24th starting point. That is technically where the Santa rally begins, okay? So we are not at that level yet, which means if we don't get here to around 59.80 on the SPX by the close tomorrow, this would be a negative Santa rally, which would be a negative Santa rally in 2023, a negative Santa rally in 2024. That would be the third time in history since 1970 that we've had back-to-back negative Santa rally windows. Now, does that mean anything for the context of the market? No, because 2023 was a huge bullish year. 2024 has been a pretty darn good bullish year. 23+% in the S&P, 29% on the Nasdaq, 13% on the Dow. So it just means that the market kind of limped into the finish line if we don't get into a positive, holiday rally. But what I think is interesting is take a look at this right here. Okay. This vertical line should be right around the beginning of the year. Okay. This should be the start of the year's trading. And if you look at the sector performance, going back to the last year, it's like, oh yeah, like every sector is green. Materials are down. But what I want to show is look at how ugly the finish was for pretty much everything. Everyone got all excited in November for the Trump trade, but look at the trend to finish the year. Lower, 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 lower. Does that mean profit taking? Does that mean there's things to worry about? We'll find out. Okay. But it was not a good way to finish the year, that's for sure. They still clung to some positive levels, but we saw, 15% crashing down to 9%. We saw, 15% crashing down to 3%. That's a big change, right? And that is, real estate took a big nosedive when rates aren't getting any better. Energy took a huge nosedive, and I mean XLE. Take a look at just the sector itself. XLE. Okay, look at that. So big wipe towards the end, and I mean it's just kind of been range bound, right? So is XLE like a good range trade? Yeah, I mean $83 to $84 looks pretty good for range. I just think we're gonna have to trade a lot of volatility. I go back to the same narrative we talked about the last few weeks. It's been a heck of a run since the bottom in 2022. We've had a great run. We've had a few hiccups along the way, but nothing that really derailed. I would like to see the market make a bit more of a corrective play. I get more concerned as a bear if this market continues to just grind higher, grind higher, grind higher, grind higher. Like that eventually rounds itself out and maybe tops. I'd almost rather see if this is going to start out to be a bearish move. We'll see how orderly this gets. Right, orderly meaning like if it's a high, low, lower high, lower low, lower high, lower low, lower high, lower low, something like that is much better for a bull to then have the ability to accumulate and then see this kind of base out and then go higher. As opposed to what we can never really control is we have this huge volatility event and it just goes crash, right? And then everyone's panicking, and then liquidity is super thin. Right. And spreads are super wide and nobody knows what to do because the fire exit is It's right there when everyone's trying to get out. That's what August 5th felt like. That was that August 2nd, August 5th weekend when it was a wild and crazy move. Unless you had, cash to buy stuff, it was hard to exit where you wanted to exit. Okay. And I continue to see these market makers just defend like every level that is tested. It's like all it takes is one level, man. This is crazy close. So anyway, we'll see. But for the day, here's where we're at. The weekly candle is still red. That shaded red is my weekly candle. We have not taken out the PCE low from the Fed. This is the Fed Wednesday, and this was the PCE low on Friday. This was the attempt to get back into that holiday spirit, come back and eat into that FOMC liquidity. But here we are, like not below the lows, not above the highs. Market's just chopping around. Could we take out a fresh low for the week? Possibly. Could we take out a fresh high for the week? Possibly. I don't know. So to be determined. But it's a brand new year. I soaked in a lot of content Tuesday afternoon after the market closed and Wednesday, and it's some interesting outlooks. I've got some smart macros that are calling for two scenarios. Okay, like I'll give you the list. Trying to think. If we have macro, I'll just put macro outlook for 2025. Okay, I can read off a handful of catalysts. So here's some things. And again, they're going to sound pretty negative. So just take it with a grain of salt. We're seeing China put in more stimulus. They're kind of fixing the yuan. I think the dollar is going to be a big play in 2025. The dollar's probably going to get a little bit stronger, possibly a lot stronger before there's a bigger macro move bearish on the dollar. So we have, let's see here. Got a lot of geopolitical stuff going on. CIA officer warns of imminent threats. You got this Bourbon Street attack, Tesla explosion. Saw the Tesla, the Cybertruck that exploded right near the Trump Hotel. Gold rally due to central bank buying signals risk aversion. There's a lot of stuff going on with Russian gas and energy in the Eurozone. Geopolitical tensions lead to maritime shift away from China, disrupting global supply chains. Trump tariffs, of course, a big threat coming into 2025. U.S. manufacturing PMI index decline. U.S. We shouldn't even pay attention to manufacturing PMI. Like we're not a manufacturing country anymore. It's silly to think that we are. Everyone's using PMI numbers like, oh, below 50 in the manufacturing PMI is a recession. No, it's not. We're not even a manufacturer anymore. We don't make anything. So, I mean, services, yeah, if services are below 50, then we have problems. So anyway, China's looking like they're a little bit worse off. We've talked about the cracks elsewhere. It's not just the U.S. U.S. has been pretty resilient. It's carried the global economy for the last couple of years. If there's enough global cracks to kind of drift into and seep into the U.S., that's a problem. If the U.S. can't just keep everything going the way it's been going. Anyway, so I have, and just like I said, take this with a grain of salt. Will 2025 be like 2008 or 2022? That's some content that I soaked up yesterday. All it is it's one trader, smart guy. Seems like he's pretty calm, cool, collected, but he's crazy bearish. Like he's got puts on everything out to April, puts on everything out to the end of the year. He's bearish on semiconductors. He's bear. I mean, it's like I'm not saying he's right. It's just like interesting perspective. Okay, so that was kind of one. Two will be tech, capex, AI, and AI agents for 2025. Will that be where the growth is? So is it still, do you play Mag 7? Do you rotate away from Mag 7? The thing I'm worried about is Mag 7 and top 10 is so concentrated. So concentrated. Let me find some screenshots here and read them out. Just some interesting stuff. So market cap of the largest stock relative to the 75th percentile in the top 10 stocks. So right now, the last time that just 10 stocks accounted for 38% of the total market cap was just before the Great Depression. That's a Goldman Sachs chart. The number of unsold completed homes. So this residential construction thing is a big deal. You can find this on the Fed website. Residential building construction continues to go higher, but I'm watching residential construction employment. That starts to take a hit. The housing market's going to be a little bit slower. It's not going to be as fast and obvious, but 2025 we could have something happening in that space. Credit spreads are a little bit higher. If you look at the high yield index option adjusted spreads, we're starting to see an uptick. So your symbol is JNK. That's showing that we are potentially seeing some widening credit spreads, a little bit less liquidity in the markets now. Gas prices, watch the pay at the pump. Home builders ETF. Quantum stuff. And then we have 2025 debt prices, restructuring, financing, higher borrowing, and then a rising in for delinquencies and bankruptcies. I spelled that wrong. Quincy's, yeah. So this is happening. Like under the surface, is it back to like crazy crisis levels? Maybe not, but it's something to watch. So I'll just put this in perspective. I'm a happier bull. Actually, I'll put this too. Sentiment is overly bullish right now. Kind of. It's not there yet, but we know how quickly sentiment can change, like very fast, right? Like the Fed day, for example, the 18th, it pretty much squashed a lot of that sentiment. We could have a big reset. I'll take a look at the AAII and the Fear and Greed Index. But a lot of things were overly bullish, and it was right around that time that the Fed kind of rattled the markets on the 18th. So, again, if it's so crowded on one side, I tend to be a little bit more cautious. If everyone is bullish and everyone's throwing money in the stock market and everyone's throwing money at, example being, Fartcoin. Okay. Example being like everyone's jumping into quantum computing, everyone's jumping into, or just sitting in Mag 7. It's like, if you weren't in Mag 7 in 2024, you pretty much didn't make any money, right? What carried the SPY and the QQQ higher? Mag 7. You want to throw in some semiconductor stuff? Yeah, sure, maybe earlier on, but mostly it was Mag 7. That run from Thanksgiving to the Fed on the 18th of December was all Mag 7. That brought the markets to higher highs. Okay, so what am I doing with it? Here's what I'm doing. Protection on all owned positions. Okay, a really simple one is a collar trade. That is basically a free hedge. Okay, so if you own shares, and again, you don't have to do this. You're going to cap the upside if you do this, which never feels good. But for me, my mindset is more, I want to protect the downside. So if I own shares, which I have shares of Amazon, shares of Nvidia right now, I have a couple of tranches in the SPY. What else do I own? I got rid of AT&T. I still have some Chewy shares. I own some Alcoa. I own some Philip Morris or Altria, but they're covered. Okay. So point is, I'm adding collar trades on everything, which is I sell a call above price to let it drift higher and get it called away, and I'll reestablish a position if it's stock I want to keep owning. But when I sell a call, I buy a put below it. So my buy put level will protect the downside. My sell call level is the premium. And usually when I put those trades on every, let's say 30 days, 60 days for expirations, I can do so with a small credit. I can lower my cost basis a little bit. And if the price goes higher, it gets called away. If price goes lower, I've got the put there to protect. I did this in MicroStrategy as well, which, by the way, right now, MicroStrategy is, where'd it go? 302. My break even on MicroStrategy is 294, and I've got a cover call at 305. So I don't think that's that far out. I think this might be, if it's not this Friday, let me check. Let me check my MSTR for a second. MSTR. There it is. So I have the shares, and there is my, there it is. There's my 245 put, my 305 call. That's out to the end of this month. So whether we are going higher or lower, I'm going to look to have some type of protection on MicroStrategy. So let me have a look at the chart real quick. MSTR. I've looked at some symmetry down towards 241. I would say if this is going to be highly volatile between the 240 and the 200 level, and that's kind of it. Like, I don't mind lowering my cost basis. My concern is that MicroStrategy is going to be like the bubble stock. Like, I know that this is a peripheral of Bitcoin, but I mean, this thing is down like 50%, right? It's down 47% from high to low, and Bitcoin is down like 20, not even. Right, we're down 15, almost 16% on Bitcoin, or that's a correction from high to low. We hit symmetry, pulled back around 16%, and Bitcoin right now is only about 11% off the all-time highs. And MicroStrategy looks like absolute trash, right? This looks like a 2021 tech bust, deleveraging. It's down 47%. So, how's everyone feeling about those? Who's my MicroStrategy double leverage traders? Who are those idiots? Just kidding, but not really. You enjoy it on the upside, but this is the problem with the downside. This thing's down 40+%. You got this thing leveraged. You could be down 70 to 80% on that instrument. This is why I've been saying for months, it's like, that is the dumbest play. Like, stop trading these leveraged ETFs, stop trading these leveraged derivative instruments, because they're good when they work, but they will crush you when you're wrong. So hopefully that's nobody. But can't say I didn't warn you. All right. Oh, I get it. I mean, look, this whole Trump tariff thing is, it's a playbook of 2016, right? We started like with this very harsh rhetoric of tariffs, and when they really came into reality, it was like there were some tariffs, but it wasn't as harsh as what it sounds. So it's more like it's the threat, but it's not as bad. And I think Wall Street's kind of feeling that out right now. You know, um, look, I think the bigger threat to the markets in 2025 would be this. Then just again, opinion here. What are the biggest threats to the markets in 2025? Honestly, it's the Fed. You know, um, if the Fed, well, and it would say that, I mean, they're forced to give us so much transparency. They're forced to be reactive. They're forced to use lagging data, and that has always caused like all these issues in the markets where it's like, the Fed's gonna, we got to wait. We got to hurry up and wait. We got to wait. Well, eventually, when the market catches wind of things, like, they price it in. And if the Fed, you know, I'll put pivot here, pivot from, dovish to neutral, becomes hawkish, where a potential hike is on the table, that's bad news, right? If the Fed is going to like be forced, and forced meaning like inflation's going higher, things are getting worse, the economy's starting to get brittle, employment's starting to rate, if unemployment starts to go up, if the economy is slowing, if inflation is sticky and rising still, it's like, does that mean the Fed has to backpedal? Like, that would be potentially, as far as the market reaction, that could be one of the worst things that would happen to the US market, is the Fed is no longer going to be accommodative, you know. And again, and they're going to take a ton of heat for it. And everyone's going to be pissed about it, but the reality is, if that's what happens, is what happens. If the Fed has to do it, I mean, I'd rather them say, look, we don't like the way things are going, and we're going to stop cutting rates because Inflation's going higher. We're at a brittle point of the economy where we want to continue growth. We want to continue financial stability and blah 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 and hit our mandates. But inflation is now back front and center with something we have to pay attention to. To avoid a second wave of inflation, to something, right? Like, be honest. There's no way the Fed can be dovish with the inflation doing what it's doing. It's been 3 months trending higher. It's way above the Fed's target. They are fooling themselves if they truly think that they're going to get to 2% anytime soon. So if they are neutral and then they take this as potentially more hawkish, they even consider putting a hike on the table. I think that's really bad news for the market because that's something that the market can price in. Okay. Is the market pricing in any rate hikes this year? No. The market's pricing in and has been pricing in for the last 6 months. It's been pricing in how many cuts the Fed's going to give us. So now cuts have been priced in. The 100 basis points of cuts have been priced in, but the complete opposite effect in the 10-year yield going up 100 basis points, that's where the inflation is getting stickier, right? So anyway, the Fed could be a big reason that things break down. I think that also not just the Fed, but geopolitically, do we have a trade war in 2025? Maybe. Do we have brittle financials elsewhere, right? Is Europe in rough shape? Is the UK in rough shape? Is Japan in rough shape? China, world number 2, are they struggling? Everyone's calling like China sucks. China's uninvestable. China's worse. Maybe it is, right? But if all this is like it's non-US, 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 well, this is still the global economy. It's like the US can't be on its own island. Like US is the best ever. No, it's you know impervious to any type of geopolitical risk. It's totally not. So if there's cracks in the European economy or the UK or Japan or China or elsewhere, India for that matter, emerging markets for that matter, all these things, they can leak into the US, right? They can leak into the US. So that's a problem. And then maybe let's talk valuation. I'll get into some charts. Valuations and sentiment. I had a conversation with somebody last week, and asking the question came up of like, are you a technical trader, fundamental trader? I mean, if I'm a trader when it comes to like trading forex and trading like the futures market, not options at all, just trading like futures and price action. Technically, yes, trade technicals and forex, trade technicals and futures because you get pure price feeds. Even technically in Bitcoin, but not really. Just because we've kind of had like the buy and hold mentality for the last few years, and you've been rewarded for that. But when it comes to the stock market, I don't think traders put enough emphasis on how important sentiment is, right? Sentiment is crazy important in the stock market. The psychology of risk on, risk off, or risk appetite. When you're confident, you buy things. When you feel like you have like real wealth or paper wealth, you buy things. It's like the mood of the market is really important. And we've had a really bullish, almost euphoric market the last like several months. So 2023 to 2024 has been a great 2.5 year run, roughly, right? You get into Q4 of 2022, October was the bottom. From that point to now, the market's gone up over 70+%, and we've pulled back some, but it's still a heck of a run for that bottom to top. That's a huge rally in the last 2.5 years. So at this point, when it feels like, Trump's president, everyone's optimistic about what it's going to be for the next 4 years. I'm not that optimistic. I think that the market clearly got ahead of itself. We faded a lot of the election gap, and that's still a concern. Like if the market doesn't hold on to those prices and we come back and fill those election gaps, okay, well, there's certainly more pressure to the downside then until the market's going to stabilize. So these big swings in sentiment, like it's extremely bullish right now. And I think that has to get the air has to get let out a little bit. So this little correction post Fed has been understandable. If there's more to it, I'd kind of welcome it, at least in the near term. I would love to see I've said this before, like 5 to 7% correction, 7 to 10% correction, and then we start looking to reestablish some support, maybe some indecision, right? Maybe a lot of consolidation in 2025. So I don't just automatically go from a really nice bull market into a really quick bear market. Usually it doesn't happen like that. Usually there's some type of transition phase. Usually there's some type of consolidation phase, and the market tries to hang in there to see if it's justified. We can go higher at these high valuations, but if we can't, then we start to correct. So we just had extremes, you know. So I just want us to be aware that like sentiment is a big deal, and all it takes is if sentiment shifts where all of a sudden no the herd is no longer as bullish, if people are running to the exits, if liquidity is drying up, if there's money supply that's going down, if stimulus is no longer as freewheeling as it once was. I mean, these are things that cause a bit of a liquidity crunch, and that's typically not a good thing for the equities market. The bond market, the U.S. bond market. I hate the bond market, but it's probably something that's going to matter in 2025. The 2 year sitting at 4.23. So your Fed is trying to control. Think about this for example, the Fed is trying to control the short end of the curve. Them cutting rates is controlling the short end of the curve, and I say controlling, it's doing the exact opposite. Right? Fed cuts and the 2 years up, 71 basis points. The Fed cuts and the 10-year is up 97 basis points. So it's doing the opposite of what the Fed is doing. The Fed has been cutting and the 2 years up, the 10 years up. This is how we got out of those inverted yield curves, right? The 10 and the 2, you can see that the 10 is much like the 10-year has gained a lot faster and outpaced the 2 year, which is why this is now disinverted. The 10-3 is now disinverted. This does, historically speaking, for the last 40, 50 years, make me very nervous that we're on borrowed time for a real strong 2025. Okay. And I keep going back to this. I know there's a lot of arguments out there, and maybe nobody's paying attention to this, but I've said if you want to trade the markets in 2025, here's two charts to watch: DXY and the US 10-year. Okay. If the US 10-year gets above 5%, if we're lucky, and I mean this, if we're lucky, we will see the market actually respond in a negative way that will bring rates down. So I don't know if like the yields lead and then the equities market falls, right? If yields go up, okay, yields go up, bonds go down, equities gets dragged down with it. And if that is the case, then maybe we see the yields start to balance because the market's looking for a reason to get long again. But my concern is that if there's going to be a reaction to this, it's going to be when we're above and we're going to be greater than 5%. Okay. And we're going to go into kind of this uncharted territory where then all of a sudden we're going to freaking break. That's my concern, is that this breaks the market first. Okay. Because if you look at this thing going 100 basis points off the lows, we're sitting about 4 to 5% off of all-time highs. That's nothing, you know? This has a lot of potential consequences for going higher, to take us from, 4 to 5% away from all-time highs to like 10, 15, 20% away from all-time highs. So yeah, there's some scary stuff that's out there, that's lurking in the background, just to be aware of it. So um, I do think the 10-year yield is something that could break businesses. I think it could break debt. I think it could break private equity. I think it could break debt refinancing. I think it could break housing. I think it could break everything. Everything when it comes to borrowing and anything financing in like terms of 5, 10, 15, 20, 30 years, it'll break it. It's making stuff more and more unaffordable because, you're not borrowing based on the Fed rate. You're borrowing based on the 10-year. Okay. So point is, all this is out there lingering. I'm not saying it's going to happen, but I want to have protection. If all I have to do in my portfolio is sell a call and buy a put and let the market do what it's going to do, I feel a little bit better. I can navigate. If the market wants to go higher, I get stuff called away, reestablish positions. We'll climb the wall of worry together. We'll make some money. But the last thing I want to do is have exposure where if the market wants to go down, and we know how quickly the market runs for the fire exits if things are bad, like look at December 18th. Okay. If we have another handful of days that are like that, where it's a 2-3% sell day, we can wipe away all-time highs real fast. We can have 10% corrections real fast. And that momentum, scares people into jumping back into safety and not getting back into the markets. And who knows? It's like, do I know what 2025 is going to do? Of course I don't. But I will say that the easiest thing for me to do in my portfolio is have protection just to be safe, you know, until I feel like the coast is clear. Maybe this market stabilizes a little bit more. Maybe things are getting better. Sure, but I don't like the sentiment right now. It feels a little rough. Or people are so blindsided thinking it's going to be the greatest thing ever. It's like AI is going to change the world. Yeah, maybe it does. But does it change the world in 2025? Does it change the world the next 3 months? Or do we have a nasty correction first? I don't know. Okay. Yeah, so James says hopefully no market break, otherwise we'll be all eating our cat. Well, I mean, that's why you have protection, man. I mean, that's why I'm 40% in cash. That's why I have collar trades on own shares. That's why I have long puts and hedges. So, it's like, as fun as it is to make money on the upside, like you're insane to think that that's all the market's going to do. You got to understand how to play the downside. You got to understand how to at least have protection in your portfolio. You know, like you got to have. There's going to be periods where you got to survive the market more so than just it's a bull market. It's a bull market. It's a bull market. You know, so the market moves up and down. We like to forget that at times when it's been a 2-year bull run and it's been a 15-year bull run. Look, if anybody's been in the market since 2008, once you got through the financial crisis of 2008, you did just fine. But the problem was it took away 50+% of the gains. So if we even come remotely close to that of like a 20-30% haircut like we saw in 2022, or a 1 month crash like we saw during COVID in 2020, that was a 30+% correction. So don't think that these highs and being off the all-time highs at 4 to 5% is safe. The market doesn't represent any reality. Okay. It's not a reflection of the real economy. It's not a reflection of really anything outside of sentiment and greed. It's fear, greed, and the psychology. It's like that's what the markets are. And we're sitting here at these valuations that we haven't seen since some scary times. Like, yep, right before that crash, we were this high in valuation. We were this high at, price to earnings, price to sales, price to peak sales. That's where we're at again. So anyway, let's talk dollar index. Dollar index. What did I say that to do on the dollar? Stay long. What is it doing? Stronger. Okay. This is a big story for 2025. I don't think the dollar is going to stop getting stronger. Okay. Price isn't proving to go anywhere other than up. So if we eat through this pocket here, which is around 109.50 to 110, if we are greater than 110 on this dollar, I think we're making a sweep to these highs. I think we make a liquidity run to these highs towards 114, 115. Now, that would be a very disruptive macro trend that eventually will probably fail in amazing fashion. Okay. But until that point, I would still be long the dollar. And I've said this before, I am long the dollar, mainly dollar CAD long, dollar Swiss long. Those are my two. Okay. So dollar CAD, I still have my profit target at 44.80. Look, I think we can get to 4,500. I think we can get to 4,600. I have also seen some plays where, yeah, maybe we get to 150 because it's a big fat round number. But I'm not trying to be greedy. I measured my move. This is my technicals. Let's see if I hit my profit target, the next couple weeks maybe. Non-farm payroll is going to be next Friday, not tomorrow. So next Friday we have CAD and US numbers. If it makes a spike up to my 4,500 level, great. I'll get all my take profits on my 7 positions. Dollar Swiss, I'm still going after. Dollar Swiss, I'm going after 9,200. We're at 91.07. So I'm closing in with my, 25 positions, trying to get this hitting 92. I love this trade. Could it go higher? Sure. It could double this, right? This low to high could double the symmetry up here, but I don't want to. I mean, I built all these positions for the last couple years, and if it hits my profit target, I'm going to be happy there. So I'm trading dollar long mainly by those. I'm still testing Aussie dollar, okay, which is now starting to get to my lower ranges. This is back to the 2022 lows. I'm willing to take this down into the 6,000 area. 60.20 is another pending order. I'm also willing to trade this, and I get this. I'm so early to this trade, and most traders are like crazy nervous about like, oh my gosh, Chris, you started trading this thing at 6,300. What a stupid trade. Well, when I'm in for mini lots or micro lots at 6,300, I could care less if I go from 6,300 down to 5,500, and I take maybe a total of 1 mini lot, and I'm upside down a few $100. Because if I'm right in this trade, look, if I'm right anywhere in here to the upside, or anywhere down here to the upside, I can turn that into profit, no problem. No problem. So this is one trade that I will continue to hold a little bit. Same thing with the New Zealand dollar and ZD/USD. So I will continue to hold these levels. Okay, will I add more to them? I'll wait. I mean, if I'm going to scale in more, I'm in 3 small positions on New Zealand dollar. If I scale back in, I'd probably say like 50, maybe 5,500, and maybe down to 5,000. I don't know if I have to go that low on this chart. I would hope that I don't, because this low from COVID is still right there. Hopefully that's not the case. China probably needs to pick things up a little bit if Aussie and New Zealand are going to do better, or we have to see a bit of a return in commodity strength. But we're just not seeing that right now. We're seeing the dollar essentially. It's like kind of pulling back into like milkshake theory all over again. That's what it feels like, with the dollar going basically straight ballistic since like September of this year. But I don't mind staying long New Zealand dollar, Aussie dollar with really, really small trade sizes, and then kind of ride them out. Meanwhile, I'll ride my dollar CAD to profit targets. I'll ride my dollar Swiss to profit targets. I'm not short euro dollar or pound dollar, but I did say this: don't be surprised if we go to parity. I mean, it's a terrible entry right now at 102.88. It's a terrible entry. But would it surprise me to go to parity at this point? No. Right? We've got big pockets back here. Parity is like this giant psychological number that hasn't been hit for 20 plus years until we finally did in 2022. Don't be surprised if we make a fall into parity. So do I like the euro dollar? Sure. If I traded it small enough and I want to put a stop loss, let's say above this recent high, above anything above like 105. Okay, 105 or 106, I'd say it's an invalid trade to go down to parity. But if I wanted to say, okay, I'll sell euro dollar now, I'll sell it here and I'll sell it here and I'll stop out above, I can take that risk, right? And my reward is getting down to parity. Okay. Or, I mean, we can also go through parity and bring in these same lows that we saw back in 2022. So there's still some asymmetry on the euro dollar offer. If the dollar stays stronger, there's room to run to 114, 115, And so if the Eurozone is a little bit worse off than the US economy, if the dollar is going to maintain strength and have all these bids, then parity is a real trade, So I've said that for the last couple of months. It's like dollar index, I think it's getting stronger. Euro dollar to parity makes sense to me. Euro dollar going down maybe to these lows at 95. Where do I want to start buying the euro dollar? I don't know if I'm going to buy it at parity, but I would be interested at like 98 and 96 to test a couple levels. I might take a really small trade at parity just in case it bounces in the short term, but I think we have room to get there, So am I late to the trade? Like, yeah, I feel like I'm pretty late to the trade, because I should have been wanting to short this thing at 105, but I thought, well, it's held for multiple years at 105. Maybe the dollar index is going to stop. It didn't. And now that it's broken these lows and it took out that little PMI flash crash, I think this thing is pushing down into parity. So I'm not going to chase this. And what I'm going to do is likely use this as my barometer to say, look, if we get to parity or lower, that's about the timing, I'd say, on the dollar. Where the dollar's had a run from 112 down to parity, that's a 1,200 pip move. If we go any deeper than that, like 1,500 pips, I'm going to start looking for rebalancing. So I would rather test, parity or lower with really small trade sizes, and the likelihood is that we go back to, 104, 105, just like we did here. So I'm not in euro dollar short, but that would be the trade. I mean, I don't like shorting it now. I'm not going to short it now. I just know that if you're already in the trade, I think you still have room to run. Parity could be just the nice big magnet that price is going to go after. If it gets deeper than that into the 95 or 9600 zone, great, move a stop loss. But for me, I'm going to be scooping up some very, like small trades in here to test. I'm going to test the size of this run. I mean, I guess this would be kind of wild, but if this was a like high to low symmetry, something like that, I mean, do we get down to like the 90s? That would feel awful if the Eurozone is, now like 90, euro dollar's 90. I mean, it is what it is. It's like currencies can do all sorts of wild and crazy things. If we did that on the euro dollar, when would that be like the lowest? That'd be the lowest since 2000. Okay, the lowest since 2000 if we hit around 86 or 8500. Is it possible? Yeah, it's possible. Anything is possible. Okay, but if you take a higher time frame, it's like usually this market doesn't run without having some type of pullback. And so if we have a push into parity, okay, so there's one level there, right? One level there. And I'll put this out as a disclaimer. If I start buying the euro dollar at parity, I've got to be prepared to buy this thing all the way down to 8,600. No joke. So I've got to be prepared for potentially like a 1,000 pip area to be buying small to try to get price to turn and go my way. Right? And would I do that? Yeah, I would do that. I'd buy it really small. And if I can keep my, let's say from parity down to 86, I can keep my drawdown like less than 3%. If I can keep a 3% drawdown and then add, meaning like I keep it 3% or less because I trade really small, and then I add to my winning positions, I could turn this into a, 6, 9, 10+% gain to the upside on a price pattern. Right? So if this, falls like it does and then coils here, then starts to go the other way, just look at the big magnets. So if we fell here and we bounce back up to 105, I could see that trade happening. If we fall down to 86, we bounce back to 105, I could see that trade happening. Are we going to drop all the way to 56 and not pull back? Probably not. I think the markets are more liquid, they're more sophisticated, there's more structure. I don't think the dollar is going to have that type of sustainable run unless we're going to have like we'd have like some type of financial meltdown if we're going to have the dollar get that strong. So don't see it happening yet. But I think parity is a very real target. So if you're short euro dollar, I think you're in a good position. I think you stay with it. You ride this dollar strength out. Whether it's the first quarter of the year, it's the first half of the year, I have no idea. Okay, but food for thought. You still got a couple hundred pips to go. I mean, 280 pips is pretty good. So let it run. Pound dollar. Pound dollar crashed pretty hard from the 134 highs, and pound dollar again giving a lot of it back. So do I have a level here? I mean, 120 is probably the level I'd look at. 120 is always kind of been this like interesting psychological spot. Same thing with the 130, but we're running. If we have any pullback here, I'd still be looking to fade the pound dollar. So does it go, down towards 120? Yeah, I could see that. There's a lot of support and structure in here, which means there's another 374 pips. Dollar strength, pound dollar gets weaker. Could it get worse? Yeah, but that was a 2022. I mean, I don't know. That was a wild move. That was a big deleveraging. We didn't hit parity. We didn't hit parity on pound dollar, but I think the euro dollar to me seems a little bit easier. Pound's going to be a little more volatile, but pick your poison. I mean, I think at the end of the day, it's pretty clear. Like the dollar's getting stronger. It looks like it's getting stronger. It's literally right out of the gates for January, getting stronger. Oops, DXY. There you go. So is there anything stopping this dollar right now? Well, there's one spot, and it's pretty much right here. So if the dollar turns, then perhaps this whole talk about dollar strength is going to be faded quickly. I'm way more interested in this area, and I might not get the trade. But if the dollar index comes up into this zone, it doesn't mean I'm going to force sell trades, but it means that I will be actively looking for patterns to confirm a sell trade. So that means there's room for the dollar to get stronger and still continue to go higher if we get above, I said 109.50. Okay, 109.50 to 110. If we're greater than that, this is just in open space. Don't fight open space in the Forex market. Okay, this has been a strong trend. I was thinking for a second here after we swept these highs that a run here, maybe a pullback to find a flat pattern and then we go higher. I don't know if we're going to get that. I mean, if this is going to go, it's like we've seen this dollar do this stuff where it's like when it goes, it goes. And if this is going to keep going higher, cool. That's going to crush a lot of Forex traders' hopes and dreams trying to fade moves, right? Oh, it's overbought, it's oversold. I'm going to fade it. Don't. You know, it might stay overbought for a while on a lot of time frames before we hit to this hit these bigger levels. So just saying, right? And then the yeah, dollar cat I talked about. I'm just gonna ride this one higher. I mean, I'm almost out of this trade. So I built a dollar cat position once we broke above 3,900. 39 to 39.50 started scaling at the 4,000 mark. I've got 1, 2, 3, 4, 5, 6, 7, 8, 9. I've got 10 positions running on the dollar CAD. So I started to buy those in here, okay, and then started to add on the breakout, and I've stacked in those other trades. So I've got 10 positions running, and again, I like this profit target at 46, but I measured the move on my chart, and it's conservative. I didn't take this high, I didn't take this low. I was a little bit more conservative with my measured move, and it's right there. So I would not be surprised in like Friday. I think I could hit this profit target by Friday. And so that's 10 positions from roughly 3,600 into the 4,000s, all running to 4,500, all turning profit. That's a huge chunk of profit. Okay. So do I like the trade? Yep. Am I going to stop? Am I going to get back in on the dollar CAD when it hits profit? No. Like that trade is done. Like mission accomplished. Take these positions, turn them all into a bunch of winners, make money. Move on. Dollar Swiss, same thing. Okay, we're only 85 pips away from my profit target. Well, if this gets to 9,200, I've got 20 some positions I built since 2022. I want this thing to come back in this pocket at 97 or 98. But if it hits 92, I've got literally all my positions in profit. I'm going to take the profit. So, has it required some patience? Yes. But when it's done, and I'll go find another trade. Okay. All right. Any questions on the dollar stuff? Dollar yen. Anyone has opinions on the yen? I don't know. I mean, the Japanese yen, the Bank of Japan, they could play some silly games this year. Again, we could have some more manipulation. We could have some more deleveraging. We could have some more intervention. Who knows? So I still just think the only way I'm interested in trading the yen would be through the Japanese yen futures, which interestingly enough is coming back down to a level I think is somewhat attractive to get long. The reason I would also trade Japanese yen futures as opposed to trading currencies is I don't want to pay negative swap, right? I don't want to pay negative swap. So, I mean, is this the time to get long? I don't know what I have on my number one. Can I trade M6? Can I trade micro anything? Micro euro, micro euro, micro euro, micro pound, micro Aussie. I can't trade micro Japanese yen. Fudge. MJ, M6J. Crap. Nope, I can't trade micro Japanese yen. So anyway, there it is. I want to look at the expirations. So I can go out to September. I go out to September. So right now, so going in the money on a bull call spread, I get a 1-to-1. If I go slightly in the money further, there's a little edge that I would consider taking. I would do this so there's no assignment risk. So a bull call spread. But now, I mean, I've got to get price. Current price is 0.0065. 0.0065. And I've got to go all the way up to 0.00. Oh, wait. Hang on a second. Wait. All right, this should be better. Let's go here. Okay. So I can do an at the money, risk 262 to make 362. I can do that trade. If I stack, let me check this out. So that's not bad. So right there, I risk 287 to get 337. Risk 312 to get 312. So that's an in the money bull call spread, and it's a 1-to-1. If I go one strike higher, so it's closer to at the money, 287 risk for 337 profit. If I go one strike further in the money, 262 for 362. Now I'm giving myself a little bit of an edge here. 362 divided by 262. So I'm looking at about 138% return on risk here. That's not a bad trade. Going out to September, I'm essentially just looking to see, look, nobody knows what the Bank of Japan is going to do. I don't know what's going to do. I guess my concern would be, if this gets down here, at least my risk is defined. If we have something bad happen and this starts to go back up like we had that August to July or that July to August move, then the only other drawback that I have on this trade is I still have a sell side to the trade, which means if I want to take full profit, I'm going to have to essentially wait to expiration. Okay. But if I start my trade at a 0.00655, 0.00655 is right here. So that's an in the money call spread. I mean, realistically, I would say if this goes a little bit lower, it's hard not to just want to take this position now, and just say like I'm early. But I think that's the problem is like I'm early doesn't mean that I'm right. You know, I could be right on this trade, but I could be wrong on my timing. I don't know. Um, so almost I'd almost rather wait for this chart alarm to get hit, and it's sitting right here. So if this chart alarm gets hit, then it's probably go time for me to say, okay, I'm gonna at least get some trade in for some exposure. So example wise, if I was gonna say, okay, I'm gonna risk $500 on this trade. Well, if I risk $500, I get 750. If I risk $1,000, I get $1,500. Like the reward to risk is favorable. Okay. Um, if I went one strike further, now I risk 950 to make 1,500, 1,550. So I can set it up in such a way that like I can take a defined risk trade. That to me is a much easier trade than Japanese yen in the currency market with negative swap. So if I'm going to trade the Japanese yen at all, this is exactly how I'm going to do it. All right. So food for thought. I will be watching the Japanese yen a lot, only for this exact trade. Like this is the only thing I'm interested in, the Japanese yen. So for 2025, if you want to ask me, Chris, look at the dollar yen, Aussie yen, CAD yen. I'll look at them, but I'm probably not going to touch them. I'm not going to trade them. This is the only way that I want to have any type of Japanese yen exposure. It's going to be through the futures market. Okay. All right. Yen as the opposing safe haven to US. Yeah, I agree. And it's like, look, it's safe haven, but it's not. I mean, we haven't had the dollar's been the main safe haven. So if all of a sudden the dollar starts to continue to get all this strength and all these bids, and it's like the dollar has all this yield and the Bank of Japan doesn't. So, I mean, I think the Japanese yen to get stronger is going to have to be either a high degree of manipulation and intervention by the Bank of Japan, or it's going to have to be like a liquidity grab. Like the fear in the market will have to be enough so that you're gonna force the hand of the market to deleverage. That's what happened in late July into August when we had that little scare. If we see that again, I think that's the only way the Japanese yen gets stronger is like this big fat hit the exit button, hit the deleverage button, and just dump positions because you have layers of layers of layers of layers of Japanese yen loans and risk on top of that and leverage on top of that, the carry trade, the swaps on top of that. If all of a sudden it's like just get out and get out of all the risk, then the Japanese yen gets stronger. But it's like it takes a long time to get there. That's why it's always it's a tricky basket to trade. And now because you are paying negative swap, it's a super expensive one to hold in the currency markets, which is why I don't want to trade it. So that's why I'd rather trade futures, make it define risk. There is no swap. I pay commissions, but there's no swap. To me, that's way better. So I'm going to watch it. Okay. Cedric, good question. I'm 42. I started trading when I was 18. So I got real serious about trading around 2000. 18, started an investment club. My brother and I, we had some friends and family involved. So we had about 15 people in that. We traded from 2000 to 2020. The only reason that club stopped is because we had a lot of profit. And my brother worked for a university that closed, a little college that closed. And all the professor friends that were in it wanted to cash in. So, they all walked away with like $150,000 of profit and took their severance from the university and, found another job elsewhere. But we had a 20-year good run. So from 18 years old to now, I've been, investing, and I got really serious about it, trading the markets when I was cutting my teeth in the FOREX market with a currency fund manager in 2007. So for a solid, I've been like really actively trading since like 2007, 2008, managing accounts since 2010. So yeah, been at it for a while. All right. Anything else for today? So I know that today, did I do a lot of top-down analysis? No. I just painted the picture of like it's a brand new year. We got a lot of stuff to consider. Um, I've got protection on anything that I own. So in the last 2 weeks, I took on shares of MicroStrategy. I will actively manage that position. It's got a collar trade on it, so I'm watching closely. Okay, I took on shares of Nvidia. I have a collar trade on that. I'm actively watching. SPY, I have one account of mine that took on. It was a account that was migrated from like a portfolio margin account to a trust account, and that migration ended up taking an assignment. So I'm basically I'm holding shares of the SPY with a collar. I've got a 590 by 598. So I sold the 598 call. I bought the 590 put. So any downside, I'm going to ride this downside. Hopefully, towards um, my 200 EMA. If we get down to like 570 or 555, that is why I have the collar trades on there so I can protect. So that is this account here in this SPY position. So there's MicroStrategy. There's my where are we at here? This one. There's my put. There's my call. There's my collar trade. The covered call is already in profit, but there's still a long ways to go there. So more time. It's only out to the end of this month. So I mean, this is only out a few weeks. 29 days expiration, and I collected like $35 of credit. I mean, the premium on MicroStrategy is insane. But the key is don't let it slip through your fingers. Like it can so easily just fall off the face of the earth. And MicroStrategy was like a great trade, and it was a bubble. Who knows? You know, um, I hope that's not the case because if there's resiliency in Bitcoin, then there's resiliency in MicroStrategy. My concern would be if Bitcoin falls to 85, 80, $75,000, MicroStrategy might be in the absolute toilet. MicroStrategy could fall way through those. Like if you look at any type of structure in MicroStrategy, if Bitcoin falls down to like, let's say, 75K, um, I don't even know what the percentage would be, but let's say that we fall another, 20%. Okay. We fall another 20% in Bitcoin. MicroStrategy is probably falling 50%, right? And it's already fallen 46%. So we could be talking MicroStrategy could have like this giant fall from grace where it looked like the, smartest stock in the room by literally being an unprofitable tech company that just put Bitcoin on its balance sheet. And now it's trading like Bitcoin with like 10 times the leverage. So my point is, I like the premiums, but this reminds me of the trade that I did when Coinbase first came out. That with the premiums really high, but the volatility was crazy high too. So protection is really important. All right. So anyway, that's where I'm at on Bitcoin. If Bitcoin falls, MicroStrategy is going to be interesting to watch. I still wouldn't mind taking on the shares and have them assigned. I have them at 294 break even right now. If it gets called away, I actually have to update this. I'm gonna it's an income flip. Now I've got to update. It's like a 131 collar trade, which is a 305 by 245. And the new break even is, let me go to my tracker here. And I had this all in the Pulver alerts too, by the way. So, I mean, if anybody's taking this journey with me, you can be in the same trade. So my break even is 291, 291.20. So if it gets called away at 305, I'm making $13.80 a share. And I mean, I've lowered my cost basis from 346 down to 291 in 2 trades. If it goes lower, then I know that my put, the long put was a 963 debit. So I'll be watching that to see if I can turn a 963 debit into more profit. Then I'll continue to lower the cost basis. If I do take profit on the put, I'm also going to take profit on the call and then reestablish another collar trade. Like I will repair this trade for profit because I don't think MicroStrategy is going to zero. But I think if we came down to 241, that's a symmetry level. We came down to 200. That's a big breakout level. So I could see this stock where it's like my job would be to take ownership and aggressively lower the cost as low as I can. And, I'm not looking at it like, well, if I lower my cost base to $240, I should try to ride it back up to $500. I'd love to say I'm going to do that, but that's not what I'm going to do. The reality for me is if I lower it to 240 and I turn it into a profit of 10, 15, 20 bucks a share, I'm going to do that. I don't need it to get back to $500. You know, I want this to be like if I can take this and turn it into a, 1 to 2% gain over some option trades and maybe 30 to 60 days, I'll take that and I'll do that like 50 times, and I'll make some money. Pretty simple, but it's active. And I think that's what my 2025 is going to be. It's going to be find something that I think I can work, find something I think I can grind on and actively churn the income. And that way it doesn't matter if the market goes up or down, I'm going to do my best to try to generate the income. Because even in a bear market, we're going to have bounces. So am I bearish and everything? No, but I've got protection just in case. And I think the market, if we do have some type of downward move, we will have a thrust, right? And then that gets faded, and then we have a thrust, and we get faded, and it gets worse, and it capitulates, and then we stabilize and we start to recover. So what you're trying to do is have protection where if it gets really bad, you want to make sure you have protection in these zones when the market doesn't pop and it doesn't go up. Like where the bulls at? Well, they could be absent for a capitulation move. And so if you don't have protection, that's when your portfolio gets really bad. That's why I want protection. Make sense? All right. And another thought macro wise this year is that Bitcoin somehow emerges as like its own, I don't know. I dare not call it safe haven. But if Bitcoin performs well this year and the markets do not, man, we are having a crazy regime shift if that's the case. Okay. But my concern would be that Bitcoin is as tied to risk appetite as the stock market, you know? And so if we see the stock market getting beat up a little bit and heading lower, I think Bitcoin goes too. The amount of outflows we saw in Bitcoin since the Fed was like really, really high. Record outflows since the highest outflows we saw since December of 2022 since the Fed. So like literally the last 2 weeks, we've seen more outflows in the markets across the board. That's on Bitcoin ETFs. That's on gold. That's on S&P. SPY and Qs. All the ETF outflows were like as high as they were back in December 2022. So again, people taking profits, exiting positions. Doesn't mean they're dumping into safety. But anyway, Cedric says, have you ever gone dead wrong with that kind of strategy? No. But the point is, I would never want to relinquish the protection. The only way I'd be wrong in that would be if the stock went to zero and I lowered my cost basis down as far as I possibly could, then I'd still eat the loss. Like let's say that I get MicroStrategy's breaking down to $30. Okay, well I took a buy trade at $346 and the stock goes to zero. And my break even, let's say with my option positions and protection is like $30. Well, I'd still lose $30, right? If they delisted MicroStrategy, I'd still lose the $30, whatever my break even is. But no, I haven't, because if I exit a position, I'm just constantly removing or adjusting my options, so there's protection. Yeah. I mean, so do I trade it on stocks I think are going to zero? Of course not. I mean, usually it's like I don't like to own stocks that much anyway. So if I do own it, then I'm pretty committed to turn it into profit. So right now it's like I have. Let me see what I own. I'll go for like one more minute. I'm going to wrap things up here. What do I own? I have some shares of Apple. I have some shares of Amazon. I have some shares of Baba. I have some shares of Baidu. I have some shares of Chewy. I have some shares of Costco's dollar cost averaging. That's a small position. I have some shares of EWZ. That's Brazil. That's getting beat up a little bit, but not too bad. I'm gonna look at getting back into like the COVID lows if we get them. It's around $20. So we're at 22.77. I've got like a 20.50 alarm set on EWZ. What else do I have? Gold. I have shares of gold, GLD. I do have some shares in JD. This one is going to be, that's my covered call. I'm gonna lower my cost basis again. This is 99% of the profit. I've already shaved off $2,000 on this. That's a covered call income play. I've got $2,000 on my. This is going to be tomorrow's expiration, so I can just close this and roll it. I'm going to do that on JD today, actually. So let me do this on JD. And okay, what else? I have some shares of Coca-Cola that are protected. Let's see here. MO, I have some shares. This one may get called away in March. I might roll this again because it's a good dividend play. What else? MicroStrategy, that's what I'm talking about. I got a lot of trades on MicroStrategy because the premiums are so high. I just collected a bunch of income on it, but I decided to take some ownership, play the collar, and just try to grind it. What else? NVIDIA, I've got one account that has some shares. This one here. Actually, no, I've got 4 accounts that have some shares. NVIDIA's right here. So I have some shares, and then here's my collar. There's my covered call at 140, which is out to the end of the month, and there's my protected put at 130. Oxy, holy crap. That's a big pop in OXY. I might get this one called away. Break even on OXY. So my break even on OXY is OXY. That can't be right. Assigned at 60, added long put, rolled, break even. Oh yeah, okay. I was like, what is happening? Yeah, it's not a lot. I'll play around with this one. I might be able to roll it, but my break even is 49.20. So I'm only going to make 80 cents in this one, but 80 cents times 500 shares, I'll still make $400 income. Not my favorite. I can play around with the rolls and maybe grab a little bit more there, but anyway. So of all these positions, I might have 5 to 7 of these symbols that I actually own shares. The rest is just all options. So when it comes to owning something, then I own it, and I'm either looking at a income play, like a protection, lower the cost basis, get it called away for a certain amount, like make $500 to flip it, make $1,000 to flip it, or I like it more longer term and I'm trying to roll covered calls. But yeah, generally it's like I try to keep all my cash available to like trade options and then utilize the leverage and generate income. So anyway, I just think it's important that if I own anything, rather than being at the mercy of the market, like if the market falls, you don't want to be at the mercy of that fall. You want to be able to say like, look, I've got that thing hedged. If it falls, at least I can lower my cost basis, and I'll ride it down. I'll ride it down and lower my cost basis with it. So if this, like, just say this is a stock. Well, if this stock drops and my break even can go down with it, then I can still own it there. The worst feeling is when you own something and it drops and your break even is here and you still have to wonder like, well, how does it come back up 30% now? That's when traders get in trouble. So that's why I'm always an advocate for having some type of option trade around your equities positions, around your ETF positions, around your future positions, around anything, just to have some type of protection on the upside and downside. Okay. All right. And James, I mean, okay. I just think you're making it harder on yourself, man. James says, I don't touch stocks. I'm learning Forex and commodities. Okay. Just telling you it's a little bit harder. You're learning traders markets. Okay. Why are stocks good? Because they're designed to be strong companies that you invest in, you have ownership of, and they go up in time. What do you think the S&P is for 90 years? It's a representation of the strongest companies in the world. It is built to go up. Makes it a little bit easier than trading Forex, where the market could be absolutely sideways for 20 years. And the amount of leverage and liquidity highs and lows and the tests and everything. It's like, just telling you, it's a little bit easier to be a stock trader. But I would say not just a stock trader, but trade options, and I'll leave you with that. So anyway, that was fun. I know it's a lot of talking today, but if I drove home a couple of points, is that I don't know what's going to happen in 2025. 2024 is a great year. 2023 was a great year. 2022, I survived. 2021, 2020, great years. 2019 was fine. 2018 was fine. 2017 was fine. Like, it's all been fine. 2025, it's no different than any other year. The market's going to go up, down, or sideways, fast or slow. We're going to figure it out. But all I'm saying is there's enough out there to make me concerned that if it goes down, it could go down a ways, right? If it goes nowhere, it could go nowhere. If it goes up, it could go up. I just don't think we're going to have the same 2.5-year trend we've had. 2023 and 4 combo, the market went 70+%. An index that's supposed to be like, lower volatility, averaging 8% a year. The index went 75% in 2 years. Okay. Now that's from bottom to top. That's picking the bottom, picking the top, but that's still a relentless run to the upside. And that's where we get into those sentiment swings where it's a little extreme. So I think it's overvalued. I think a sideways consolidation period would make some sense to justify why we have these gains, or a correction and a bit of a pullback or haircut would make some sense. Okay. I always felt that with stocks and options, I would be able to beat the S&P. Wouldn't be able to. I mean, just by stocks itself, you probably can't. If you're a stock picker, historically, you're going to lose money. If you're an index trader, you can match the benchmark. I mean, there's nothing wrong with that, right? Who would be upset if you were doing 23% last year in your accounts? Would anybody be mad at 23% gains last year? Would you be mad at 29% gains? I mean, that was the S&P, that was the Qs. That's great. Okay. So, yeah, there's efficient market theory and you stay in the game. But I'm telling you, like, adding options around positions, it's a whole new dynamic of trading, and there's a lot of ways to generate income. You don't have to own a single share. You don't have to own a single ETF. You can trade options, generate income, and you can grow an account that way. You can protect your portfolio that way. I don't know. It's hard to convince me. In fact, you're not going to. Nobody's going to convince me why. Look, I traded Forex. I traded Forex for 17 years. I traded futures since 2010, 2011. I've traded options the whole time. It's like options for me since like 2014, 2015 have been what I love to trade. And now it's pretty much exclusively, not exclusively, that's not fair, but it is what I'm the most active in. I think it gives me the fairest shot to make money because I don't have to be perfect, right? I don't have to have a stop loss at that bottom or the top because it's just my strike price and defined risk. It's like there's no other asset that does that. So for all you Forex traders out there and all you futures traders, it's like there's so much manipulation at highs and lows. The market like grabs those highs and lows and spikes them and plays games with those liquidity hunts. It's like it is the most tricky thing that you can never ever get away from. So the reason I trade options on futures, the reason I trade options in stocks and equities and ETFs is because the strike price is just there as a line in the sand. And if price is going to go a certain amount of time and be above it, I can make money. If it's going to a certain amount of time and be below it, I might lose money. But I don't lose anything more than what I originally risked. So that's better than a stop loss getting hunted. That's better than a stop loss getting slipped. Right? So anyway, just food for thought. And there you go. There's Big Mike. Since I've been trading options, my profit's gone through the roof. There you go. It happens. Options can be a game changer for a lot. Cool. All right. I'll let you go. Happy Thursday. We'll be back at it tomorrow. All right. See you. Bye.
Thanks for watching today's A1 Trading Show. We hope you enjoyed, and we're excited for a brand new year of trading with you. If you're new, consider subscribing for daily videos and live streams all year long. Be sure to check out the description below for our latest deals and offers. 2025 is just the beginning of our best year yet. We'll see you tomorrow.